Ah, Cyprus, the beautiful island nation known for its beaches, its history and its oversized banking sector. Yep, you heard that right. Before 2013, Cyprus had a banking sector way bigger than its economy could handle. It was like a tiny car trying to pull a yacht. Ambitious, but maybe not the best idea. See, Cyprus had spent years cultivating an image as a financial hub, attracting foreign money like moths to a Mediterranean porch light. Russians in particular found Cyprus quite charming, parking their rubles in Cypriot banks. On paper, everything looked sunny, but beneath the surface, cracks were starting to show. The Cypriot banking system had grown addicted to foreign deposits, especially from Russia. These deposits were often much larger than the country's GDP. This reliance on foreign capital made Cyprus incredibly vulnerable to external shocks. To make matters worse, Cypriot banks had been playing a risky game, investing heavily in Greek government bonds. Remember Greece? The country that basically invented drama and debt? Well, their financial woes would soon spill over into Cyprus with disastrous consequences. Remember that whole "don't put all your eggs in one basket" thing? Well, Cyprus seemed to have missed that memo. They'd gone all in on Greece, piling their money into Greek government bonds. They thought it was a safe bet. Spoiler alert, it wasn't. When the Greek economy went belly up in the late 2000s, Cyprus felt the burn. Those Greek bonds they'd invested in, they were suddenly worth about as much as a used napkin. The value of Cypriot banks' assets plummeted, leaving them teetering on the brink. But wait, there's more. Cypriot banks had also been lending like crazy to local property developers who, shall we say, weren't exactly known for their prudence. When the global financial crisis hit in 2008, the Cypriot property bubble burst. And guess who was left holding the bag of bad loans? You guessed it, the Cypriot banks. Faced with mounting losses on their Greek bonds and a collapsing property market, Cypriot banks were in deep trouble. They desperately needed a lifeline, and they turned to the one place that might be able to help: the European Union. Imagine you're a bank. You're supposed to be a pillar of stability, a place where people feel safe keeping their money. Now imagine you're that same bank, but you've lost a ton of money on bad bets and everyone knows it. Not exactly the image of reliability, is it? That was Cyprus's problem in a nutshell. As their banking sector wobbled, credit rating agencies, those arbiters of financial doom and gloom, took notice. Downgrade after downgrade rained down on Cyprus like a hailstorm of bad news. These downgrades were like a scarlet letter for the Cypriot economy. They meant that borrowing money on the international market was about to get a whole lot more expensive. Think of it like trying to get a loan with terrible credit. You might get the money, but you'll pay through the nose for it. Cyprus was caught in a vicious cycle. Its banks were in trouble, which hurt the country's credit rating, which made it even harder for the government to help the banks. Something had to give. Section 4, bailout or bust, a €10 billion lifeline with strings attached. With its economy on the brink and its banks begging for a bailout, Cyprus found itself in a tight spot. They needed help and fast. Enter the Troika, the European Commission, the European Central Bank, and the International Monetary Fund, the avengers of international finance, but with less spandex and more austerity measures. The Troika agreed to toss Cyprus a €10 billion lifeline, but it came with a hefty price tag: austerity. Cyprus had to slash government spending, raise taxes, and, most controversially, restructure its banking system. This meant shutting down the country's second largest lender, Cyprus Popular Bank, also known as Laiki Bank. Laiki Bank was deemed too big to save and too interconnected to fail without causing widespread chaos. Its good assets were absorbed into the Bank of Cyprus, the country's largest lender, while its bad debts were spun off into a bad bank to be wound down. The bailout and the closure of Laiki Bank were just the tip of the iceberg. The Troika had one more trick up its sleeve, and it would prove to be the most controversial aspect of the entire bailout package. Section 5. The deposit dilemma, a controversial levy shakes Cyprus. Here's a fun fact. When countries need money, they sometimes get creative. And by creative, I mean they take your money. That's essentially what happened in Cyprus. As part of the bailout deal, the Troika insisted on a bank deposit levy. A fancy way of saying we're taking a percentage of everyone's savings. This wasn't just some loose change they were after. The levy was initially set at a whopping 9.9% for deposits over €100,000. Imagine going to bed thinking you had a nice nest egg and waking up to find out the government had swiped nearly a tenth of it. Naturally, this went over about as well as you'd expect. People were outraged. They protested in the streets, withdrew their cash in a panic, and generally felt like they'd been betrayed by their own government. The mere suggestion of a deposit levy sent shockwaves through the global financial system. After all, if Cyprus could do it, who's to say other countries wouldn't follow suit? Section 6. Outrage and unrest. Cyprus and the world react. The Cypriot bailout and the deposit levy sent shockwaves throughout the island nation and beyond. In Cyprus, people took to the streets in anger, protesting the austerity measures and the perceived injustice of the bank deposit levy. They felt like they were being punished for the mistakes of their government and the recklessness of their banks. Internationally, the reaction was a mixture of concern and criticism. Some praised the Troika for taking a tough stance on moral hazard, arguing that those who had benefited from Cyprus's loose banking regulations should share in the pain. Others, however, criticized the deposit levy as a dangerous precedent, fearing that it could undermine confidence in the entire European banking system. They argued that it would disproportionately hurt ordinary Cypriots while letting wealthy depositors off the hook. The Cypriot government, caught between a rock and a hard place, eventually backtracked on the initial deposit levy, reducing it to 6.75% for deposits over €100,000 and exempting deposits below that threshold. While this helped to quell some of the public outrage, it did little to address the underlying problems facing the Cypriot economy. Section 7. Scars of the crisis, the lasting impact on Cyprus's financial landscape. The 2013 financial crisis left deep scars on the Cypriot economy and psyche. The country experienced a severe recession, with unemployment skyrocketing and many businesses forced to close their doors. The crisis also led to a significant loss of trust in the Cypriot banking system, both domestically and internationally. In the aftermath of the crisis, Cyprus implemented a series of reforms aimed at strengthening its banking sector and reducing its reliance on foreign capital. These reforms included stricter capital requirements for banks, improved supervision, and measures to combat money laundering. While Cyprus has made significant progress in overcoming the challenges of the 2013 crisis, the experience serves as a stark reminder of the importance of sound economic policies, prudent financial regulation, and the need to avoid excessive risk-taking. The scars of the crisis remain, a testament to the fragility of even the sunniest of economies.